The Minority Market. Episode 15. How the Market Reacts to News and Events. Most people believe news moves the market. They wait for headlines, earnings announcements, economic data, or breaking events, assuming that price reacts after information becomes public. This belief feels logical, but it is one of the biggest misconceptions that keeps the majority reactive and late. In reality, markets do not react to news the way most people think. Prices often move because of expectations, positioning, and psychology long before the headline appears. To understand this, you must separate information from reaction. News itself does not buy or sell. People do. And people act based on what they expect will happen, not only on what has already happened. By the time news reaches the public, large participants have already positioned themselves based on probabilities, scenarios, and risk assessments. This is why price often moves before the news and behaves strangely after it. Let's start with expectations. Markets are forward-looking. They constantly price in future outcomes. When everyone expects good news, prices rise in advance. When the news finally arrives, even if it is positive, price may fall. This confuses beginners. They ask, the results were good, so why did the stock fall? The answer is simple. The expectation was already priced in. There were no new buyers left, only sellers taking profit. This is why you will often see the phrase, buy the rumor, sell the news. It is not a trick or manipulation. It is a reflection of how markets discount future information. The minority understands that the reaction to news matters more than the news itself. A negative event that does not push price lower is often a sign of underlying strength. A positive event that fails to push price higher is often a warning. Another important concept is positioning. Before major events, different participants take positions based on their outlook. Institutions hedge, reduce exposure, or accumulate quietly. Retail participants, on the other hand, often wait for confirmation. When the news finally breaks, retail reacts emotionally, buying or selling aggressively, while larger players may be doing the opposite. This transfer of risk from the impatient to the prepared happens repeatedly. News also creates emotional spikes. Fear and excitement increase volatility. During these moments, logic weakens. People overreact. Prices overshoot in both directions. The minority does not try to predict these reactions perfectly. Instead, they observe how price behaves after the emotional response. Calm observation during chaos is a powerful advantage. It is also important to understand that not all news is equal. Scheduled events like earnings, interest rate decisions, or economic data are usually anticipated. The market prepares for them. Unscheduled events, sudden geopolitical shocks, accidents, or policy surprises create immediate uncertainty. Even then, the initial move is often emotional and later corrected as information becomes clearer. Beginners often make the mistake of trading news directly. They believe faster reaction equals profit. In reality, trading news without context is dangerous. Slippage, volatility, and emotional decision-making increase risk. Most losses during news events happen not because the direction was wrong, but because risk was not controlled. The minority focuses on context. They ask, what was the market expecting? How was price behaving before the event? Is this news changing the long-term story, or is it just noise? They also understand that sometimes the best decision during news is to do nothing. Not every event needs a reaction. Another trap is narrative addiction. Humans love stories. Media provides explanations after the fact, linking every price move to a headline. This creates the illusion that markets are logical and predictable. In reality, these explanations are often simplified and misleading. The same news can produce opposite reactions at different times. Context always matters. Over time, news becomes less powerful than behavior. Trends continue despite mixed headlines. Strong markets ignore bad news. Weak markets fail to rally on good news. This is a critical observation. It tells you where the real strength or weakness lies, not in the headline, but in the response. To develop this skill, start by observing markets around major events without trading them. Watch how price behaves before, during, and after the news. Notice whether volatility expands or contracts. Observe whether price holds key levels or breaks them. This observation builds intuition without emotional risk. The goal is not to ignore news completely, but to stop worshiping it. News is information, not instruction. The minority respects information, but does not react impulsively. They understand that markets move based on collective behavior, not isolated facts. When you stop chasing headlines, you regain clarity. You stop feeling late. You stop blaming news for losses. You begin to focus on preparation, risk control, and observation. This shift alone separates you from most participants. Remember this principle. Markets respond to surprise, not information. And even surprise is filtered through positioning and psychology. When you understand this, news loses its power over your emotions, and you gain a calmer, stronger mindset. As you continue this journey, keep reminding yourself, reacting less often is not weakness. It is discipline. And discipline, not speed, is what keeps the minority consistent over the long term.